The views expressed in this podcast are not to be taken as either trading nor financial advice. Neither the announcer nor the Sirius Report make any claims to be certified financial advisors, and all reporting is dedicated solely towards being both informative and educational. Good afternoon, everyone, and welcome to the Sirius Report Market Wrap-Up for September 17th, 2024. For everybody who listened or attempted to listen to the market wrap-up I uploaded yesterday, I owe a great apology. I accidentally uploaded the one from the 13th, relabeled it, and put it out and did not realize I had done this. Luckily, Paul caught it and they removed it, so we'll try this again and hopefully it comes out a little bit better. Anyway, today, of course, is the start of the FOMC two-day meeting. Tomorrow will be the rate announcement, and we're going to take a look and see how the markets fared heading into that session. Well, Dow was relatively flat after being up over 200 points, going down about 100 to 110. It closed down minus 15 points at 41,606. Meanwhile, the S&P 500 gained a point, 0.03%, to 5634. And the NASDAQ was up 35.93 points to close out the day at 17,628. In the bond markets, well, there was a 20-year auction that didn't go so well. Meanwhile, it was driving up yields. So as opposed to yesterday, where all across the board from the 1 month to the 30-year, everything was in the red. Today, the majority of yields are boosted upward into the green. The difference between the 2-year and the 10-year has closed where it was nearly 10 basis points. Now it's at 3.647 for the 10-year, 3.607 for the 2-year. It will be interesting to see how both of these rate yields respond come tomorrow about 2 o'clock Eastern time, 11 Pacific time. In the dollar, well, the dollar, after being down into the 101 or the 100s for a couple days, did climb about 24 cents and close out the trading day in the DXY at exactly 101. Moving over to gold. Well, there was probably some short covering that took place, but it was being counteracted by gold buying as both sides try to figure and guess. Are we going to have a quarter point? Are we going to have point? Are we going to have 75 basis point? Are we going to have 0? Many different entities are trying to make their analysis and guesses, and gold, of course, is being one of them, or at least those who are playing in the paper gold markets. Gold was down $13 to close out the trading day at $25.70. Meanwhile, silver was down just 5 cents at $30.74. In the crypto markets, well, after yesterday being down about 2 to 3%, we are up 3.67% in Bitcoin. Last 24 hours of trading saw Bitcoin gain to the 60,000 handle, closing out last day of trading at 60,338, while Ethereum was up 2.26% to 2347. In the oil markets, oil has been catching a bid the last 3 days. And both the WTI and Brent were up over $1 for the trading session. WTI closed at 71.19 and Brent crude closed out at 73.78. Taking a look at some news. Well, what sectors performed the best after the first initial rate cut? And remember, this is the first rate cut since 2020. There wasn't actually any rate hikes between 2020 and March of 2022 coming out of the pandemic, but that was when they had to do 25, 75, 75, 75 because inflation was zooming out of control and they were late to the ball game. For Jerome Powell, signaling the interest rate cuts on the horizon, a cooling labor market marked by fewer job additions and rising unemployment. So, will a quarter point or a half point actually do anything? Well, taking a look historically, the first rate cut, just the first one, usually affects consumer non-cyclicals, consumer cyclicals, technology, and healthcare. And the last two are sort of, well, they're affected by everything because technology and healthcare have been the two biggest movers in the Dow and NASDAQ and S&P 500, even when we've been in this high interest rate cycle. Meanwhile, business services, industrials, telecom, and energy, utilities, finance are usually the losers in the first one. Interestingly enough, much of that is Wall Street. So is it a question of all this new all-time high in the equity markets? Are we going to see, no matter what rate cut tomorrow, are we going to see they bought the rumor and now let's sell the news? So that's going to be something interesting to look at. Just know that with the interest rate getting cut tomorrow, you're not going to see a lot of that liquidity come into the markets for about the first 6 months. Well, we mentioned about a week ago about an interesting individual, former Fed official, who used a indicator that was created by Ed McKelvey called the Sahm rule. Now, Claudia Sahm is the one who pointed this out, found the indicator, and then attributed it to recessions. And in every single instance, going back to the 1950s, when this Sahm rule regarding unemployment average in relation to the 12-month unemployment low, we have been in a recession. Well, suddenly politics have gotten in the game because Claudia Sahm is now denying that hitting the Sahm rule in this case is saying we're in a recession. Claudia Sahm claims to have invented a recession indicator created by Ed McKelvey. Now she says the indicator is wrong, even though it's been right all the way through going back to the 1950s. Now she's saying it's wrong. Here's the denial. When the monthly jobs report from the Labor Department was released in August, it packed a punch. Something called the Sahm rule had been triggered. It was like an economic fire alarm going off. Claudia said she was live on the radio, and they read the numbers out loud. I said, okay, so the Sahm rule says we would be in a recession, but Sahm says we're not. Sahm discovered the rule when she was studying previous recessions as part of a project. So here's the bottom line. Bottom line is that Claudia Sahm is not taking into account that nearly every single unemployment report going back to the last 18 months have been wrong. They've been manipulated. They've been revised down immensely the very next month. And then, of course, we have an 800,000 job sudden revision. So if we've had unemployment going back 12 months that has really not been the numbers, and she's making the claim that, well, we can't be in a recession because these numbers are too big and they just don't fit the bill. The reality is that she's accepting manipulated numbers for her assessment and cannot come out and say that we are in a recession, despite the fact that 50 other major, minor, and soft indicators. We're talking about the Kansas City, we're talking about Philadelphia, we're talking New York manufacturing. Both services and production have been below 50, which is recession. 50 different indicators have been showing recession. And unemployment, which has been manipulated, is a lagging indicator. So this can be nothing more than a political stunt. And it goes back to what we have with Brent Johnson and the milkshake theory. And we have going back to Tiffin and Tiffin's dilemma. Both of these are tied. They were accurate within their own scope. Tiffin's dilemma goes back to the 1940s, 1950s in regards to Bretton Woods and the gold-backed reserve currency. The milkshake theory is tied to the fact that the dollar and SWIFT are the primary currency of trade and commerce. And now we have this Sahm rule in regards to unemployment that is accurate, but since we have manipulated data, it is no longer the same parameters and the same variables that made the rule to begin with. So this is the problem when you have politics getting involved in economic data. You really don't know what the accurate accounting is. And the best thing to do is to take a look around you. Are prices higher? Are jobs being released? Are people becoming unemployed? That's the real economic indicator. And this is one of the reasons why we used to have 12 different Federal Reserve locations that were tied to interest rates in that location. Like San Francisco Fed would deal with the mining industry. Kansas City and Chicago Feds would deal with the meat packing plants. Every different region of the country has a different economy. And so that's why prices may be higher in California and New York, but not as much so in, say, Kansas, Arizona, Oklahoma, etc. And this is the unfortunate thing about bringing things centralized, because once everything's centralized, then politicians and economists love to put their fingers on everything, and it's no longer a market-driven economy, it's a controlled, planned economy. Take a look at some other economic data. Industrial production is flat year over year in August, despite a surge in auto production. So we had automobile productivity, but we have a drop in sales. So they're continuing to keep people employed, even though there's not as much demand for automobiles. Retail sales better than expected thanks to non-store retailers. What does that mean? E-commerce. E-commerce did quite well, but mom and pop stores down the street saw a core retail sales rising just 0.1% month over month, but the core year over year print rose to 3.9%. Under the hood, motor vehicle and electronic appliance sales contracted and internet sales surged. Well, many of you know about Nassim Taleb. He wrote a famous book going back in 2008 regarding the Black Swan. And now he's come out and talked about de-dollarization. He's getting on the de-dollarization bandwagon. On X/Twitter the other day, he said this, and this is very important, especially when it comes to gold, silver, and preparing for a non-dollar world. People are not seeing the real de-dollarization in progress. He pointed out that global transactions are still generally labeled in dollars as an anchor currency, but central banks, particularly BRICS, have been storing and putting their reserves in gold. In other words, the dollar still serves as the primary medium of exchange, but more and more countries are turning to gold as a store of value. As author Richard Turin puts it, U.S. will tout the USD's high percentage use in trade all the way to the bottom. Turin pointed out that dollar's high percentage in trade settlements is increasingly meaningless because gold holdings show reserve storage, which means that they're not storing them in treasuries, and migration of trade to alternative currencies isn't captured on the SWIFT statistics. And we proved this when we talked about a week ago, Paul and I, in regards to the fact that 17 trillion USD dollars worth of trade was conducted on the Chinese CIPS system and not SWIFT, which means it's not recognized by SWIFT, it's not recorded, and so if it's out of sight, out of mind, the West is claiming that it didn't happen. And this is why the people, back in 2008, we saw the collapse, we saw people lose their homes, we saw this happen, and people were suddenly moving, and this is why gold prices, individuals in the US were buying gold, individuals in Europe were buying gold, they were getting out of the stock markets. This isn't happening right now. As the frog in the boiling water, more and more trade is getting de-dollarized outside the dollar, and people are going to wake up one day and the dollar's value is just going to fall off a cliff. And if you think inflation is high now, just wait till when the world starts rejecting en masse for trade, such as toilet paper that comes from China, Vietnam, or wherever, or pretty much all our clothes and other types of items. Anyway, I want to thank everybody as always for being a part of this Sirius Report community and today's market wrap up. Don't Don't forget to subscribe, share, comment, like, and just let anybody know if you think this is of value and of importance. And until the next time we get together, have a great day.